Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning. This is Quincy Krosby. This is The Talking Point. It is Monday, May 22nd. Thank you for joining me. Last week was a very interesting week for the market because we had a heavy roster of Fed speak, one official after another. It was some analyst was quoted, his quote was used in a headline for Reuters, and it was, "Oh my goodness, they keep talking, keep talking. I hope they fish or cut bait," because it got to the point where we're listening to them over and over again. You know, how did they see the next rate hike, or do they see a next rate hike? Do they see a pause? Do they not see a pause? And finally, it came down to Friday when Chairman Powell was speaking, and he made it pretty clear. Look, you have the lagged effects of all these rate hikes still working their way into the economy, but you also have the effects of the banking situation, you know, in terms of credit. And we need to see how that unfolds. So in many ways, he made the case for perhaps, he didn't say it black and white, but perhaps a pause. Now, the market went up. This was on Friday. The market climbed higher as those words came out and hit the tape. However, right after that, like within minutes, the other headline came out, and that was that the Republican side of the negotiating team, the staffers, walked out. They walked out, and the market just came down. Now, it wasn't a dramatic sell-off during the day. I think there's enough belief that both sides are not going to let a default take place. Maybe that's naive, but that's what the market showed. Yes, there was a sell-off, but it was not unruly. It wasn't, sell now, ask questions later. And today, Biden and McCarthy are supposed to be meeting. We'll see how that goes. Nonetheless, we're getting closer and closer to the so-called X date, and that is the date that the government runs out of money. And so you can have a technical default, even though you're working on an agreement. That obviously is not great to have, but clearly if global markets realize that the agreement is settled, but the technicalities in the agreement have not yet been fortified, so to speak, by the document, because remember, this all has to go to vote, the market's reaction won't be as horrific as an actual out-and-out default, that they walk away from each other. Keep in mind with all negotiations, any negotiations, it's important to keep talking, because both sides can walk out. They could, posture, well, I'm leaving, I'm not talking anymore. That is not what we saw. Again, it is going to be picked up, the dynamic is going to be picked up, and we're going to see, I think, a bit more momentum this week. But overall, I think many people realize that both sides of the aisle have a constituency that is adamant about their views, absolutely adamant, and do not want a give and take on it. Unfortunately, when you have negotiations like this, there's not going to be, necessarily sides that walk out of this and say, gee, I got everything I wanted. That's not the way it works. But overall, what the American people want, which is all of us, is we want a budget that is realistic, a budget that is not unwieldy, a budget that is healthy, not something that keeps getting larger and larger, but at the same time, the American people, based on every single survey I've looked at, they want the benefits that they have been paying for, all during their working lives. So this is a difficult balance, but we've got to get this done and get it done as soon as possible. That said, again, this week we're hoping that the talks continue. That is key. And no posturing, no walking out, with an understanding that you got to be practical and get this thing moving. That's there. I sound like I'm running for office right now, don't I? But that's so important for our country. And also, The way that this week, in terms of the Fed, remember they're meeting on June 13th. June 14th is the day they set the, a rate hike or just a pause. But last week there was an idea put forth that you can have no rate hike at the next meeting and just talk really tough, right? So you're not going to raise rates, but you're going to talk really tough. That has sort of morphed into that perhaps if you don't have a rate hike at the June 14th meeting, and you may not even just because of the debt ceiling issue, if it's even if it's on the way to being finished, but there is a technical default. You can't imagine that the Fed is going to go in and say, well, this is a great time to raise rates. It doesn't make sense. They will be much more cautious. Nonetheless, the notion is to perhaps characterize a pause with an understanding that you could have a rate hike perhaps at the meeting after June. We don't know. This week there is another heavy roster of Fed speak, and I'm going to say that I'm going to pay very close attention on Wednesday to Christopher Waller. He is highly regarded. Yes, he is on the more hawkish side of the ledger. There's the dovish and there's the hawkish. However, he's considered to be a pragmatist and very strong economist, but a pragmatist. I think it's going to be important to hear what he has to say on a potential rate hike or a pause. But one thing I can say, every single speaker did mention inflation is still too high. That is key. Now, this week, we are going to have the PC, the Personal Consumption Expenditures Index. That's very important. As everyone knows, that's probably the most important reading of inflation for the Federal Reserve. And what we're looking for really is the prices paid component. Are prices coming down? That's what you want to see. So that's going to be important. The Fed funds futures market, as I do this call right now, has about a 25% probability of a rate hike coming in June. But that's, been moving up and down, up and down. We'll see after the PCE report what that probability is the level of that probability. Also this week, we get the FOMC minutes. That comes out, obviously, on Wednesday at 2 o'clock Eastern. But we are also going to have pending home sales, and we're going to have a report on durable goods, which is going to be important because embedded in the durable goods report is the core, and that is about capital expenditures, corporate spending on goods. And we pay attention to it because it's a good indicator of how companies are feeling, how they see the future, how they see their own budgeting. And so the market pays very close attention to that. That comes out on Thursday. And the other part of the market that I think we're going to pay attention to on Friday is the final consumer sentiment report. This is the University of Michigan Consumer Sentiment Report. That has gone down. But the area that we'll be focused on is the futures expectation of inflation. Important because you don't want that rising too much. It's harder for the Federal Reserve or any central bank to break an entrenched view of deflation and inflation. And so that had edged up in the preliminary report. Now, on Friday, we'll see where that is. The Fed pays attention to it. So we are going to pay attention to it as well. And the other thing I wanted to mention from last week is that the leading indicators were down. Now, we have seen a little bit of a tick up in retail sales, keep that in mind, and also in industrial production, we saw a tick up. It wasn't great, but it moved in the right direction, and that's something that, we do want to see. Overall, the earnings season will have lows this week, which the market pays attention to, particularly following what happened with Home Depot. We want to hear what Lowe's has to say. Overall, the market has been holding up. And again, to repeat yet again and again, we are concerned about the breadth in the market. It would be healthier to have more and more stocks leading this market higher as opposed to the big mega tech names. They have helped push up the market. More and more, we're seeing traders, investors, portfolio managers go into those names, maybe as a defensive, but keep in mind, many of the analysts say, look, they have rock solid balance sheets, and during periods of uncertainty, you want to be in companies that have rock solid balance sheets. We'll see how that works this week. Again, as the debt ceiling negotiations continue, we hope continue, and as we have more and more Fed speak. Oil prices are up a bit. They are above $70 a barrel. They had been down. There are concerns with the energy market looking at the possibility of a recession. And if you've noticed, more and more, there's a push out of when most analysts believe there will be a recession, pushed out toward the end of the year or early 2024. Now, with that said, the Fed funds futures market, which we do pay, we don't live and breathe it, but we watch it. They had September as the likely period for rate cuts. That has also been pushed more into the November period. So a lot of shift in expectations in the economy and in the market. And yet, the Atlanta Fed GDP now has the second quarter GDP number, well above 2%. So that certainly isn't recession-like. And part of the reason is that the labor market remains solid. And that is important because that allows consumers to continue spending. Although it looks as if consumers are being more careful and using the credit cards more. So in any event, this week is going to be an important week in terms of the debt negotiations, in terms of Fed speak, and also overall paying close attention to some of the data releases, especially the PCE, which is, again, the Fed's preferred inflation report. Have a very good week. We'll be back next week. Thank you all so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.